Hey tradeologists, today we're going to talk about technical analysis. And even though I don't put a large emphasis on picking market direction, that does not mean that I don't want to keep track of the market and try to understand at least where it's going to determine how to manage my risk. I think it's actually a pretty critical component of trading successfully. I wouldn't suggest that it's something that you can do without. I think you really need to pay attention to where prices are going, because remember, there are 4 risks in this business, but the obvious risk is price. Because if there was no price risk at all, then we could simply put on our trades, collect our theta decay, and we'd make money every single month without any risk. Price is the risk that we manage, and in order to do it successfully, we need to have an understanding of where prices have come from and where potentially they are going. What we're trying to do essentially is determine the highest probability of where prices are headed. To get started, what I usually do is I take some very, very long-term charts on the Dow Jones Industrial Average. I also take a look at other long-term charts of the major averages like the S&P 500, the Wilshire Index, or the IWM, the Wilshire 2000 or the 5000. But normally, I like to start with the Dow Jones Industrial Average because this is the oldest index that we have available to give us some information. And if you take a look at this, this is a pretty unbelievable chart. I mean, it's just, frankly, just unbelievable where we've come from. I start the chart back in 1923 here. You can see the 1929 crash here almost looks like just a little tiny blip. It really doesn't look like much at all, does it? Historically, it was a big deal. It was an unbelievable percentage drop in the Dow Jones Industrial Average. But when you look at it, boy, it looks pretty small. Let's zoom in on that just for a second and see what we can see. You can see that prices, this is back in 1929 on September 3rd. Now this is the month of September. Prices hit a high of about 380. And they dropped off dramatically over the next few years, as a matter of fact. But these 2 months in particular are the worst months possible. It went from 380 down to 270, almost a 33% decline in prices. So, but does this look familiar? Yeah, it looks very familiar. We've had a lot of different price movements like this over the last, practically 80 years. So this is not unusual at all for us to take a look at, because this is how prices move. They move up and they move down. Like I said, I don't like to predict price, but not knowing the price, not knowing the risk of price is a very dangerous thing. There's only a couple things that you really need to know about price and some technical analysis tools that I'm going to give you in this video. But you really should have a very good understanding of those tools, and they're very, very simple. Let's zoom back out again and see what else we can see. You can see that actually, because there was back in 1926, there was a huge run up in prices. You can see how exuberant these prices are. Previous to that, the high was right around 110 on the Dow Jones Industrial Average. It broke through here, and it just kept going straight up. So the fall was even more dramatic at that point. Not only did it come back to the 110 level, but it broke through that all the way down to 40 back in 1932. Was there another period recently in our history in which prices like this occurred? Of course. Let's take a very close look here. prices maybe didn't go down as dramatically in terms of prices, but you know what? From 2000, we had a pretty dramatic rise here. We broke through this level here in which I have this channel. Now this channel goes all the way back to 1932. And then here, right in here, this date is February 1st, 1995. So you've got a channel here that went all the way back to 1932 that had not been broken, and it broke in 1995. You know, that was only 13 years ago. And look at the kind of run we had from 1995 all the way to 2000. That was a pretty dramatic increase in prices there. And then it backed off, and it did fall, but you know what? It never went below that. It never went below the level here that it broke out at, back down to 4,500. So this decline that we saw over the next couple of years, from 2000 to 2003, is relatively mild compared to the decline that we saw back in 1929. Were there other periods that we had a dramatic decline? Yeah. We can go back here to October 1987, in which again we had a tremendous run-up in prices. That run-up in prices was met with some resistance in the 2,700 level, and prices dropped off dramatically from there. And yes, I mean, that was a pretty big move at the time, going from all the way from around 2650 down to about 2,000. You know, it's over a 500-point move. It was very dramatic, but look what happened. Prices continue to go up. In fact, we surpassed that 2,700 mark, kind of broke through that, came back down, and started back up again. There's an important lesson here in taking a look at these past run-ups and subsequent price declines after these huge run-ups. And I'm sure you can tell what that is now. The fact is that whenever prices become exuberant, in other words, they go up in extreme price movements compared to the levels that they were, then there's always the potential for a dramatic sell-off. That happened here in 1929. Here's another tremendous run-up in 1935 to 1936. So look at the sell-off there. Here's another one. Although the price run-up wasn't quite as dramatic, it did back off and start to go into a trading range. That was in 1946. Here's some more of a run-up, but it's a little bit more moderate. It's not as exuberant, is it? So we had a little bit of an up and down market for quite a few years here, from 1950 to 1954, until it finally broke out here in the beginning of 1954. Again, we had a very exuberant upward trend in prices that was met with some resistance and started backing off again. But what happened? Prices recovered and they went up again. Then they started to fall, and then they went up, and then they fell, and then they went up. You can see that this pattern repeats itself over and over and over again. Now this period here is very interesting. From 1966's high, which was right around 1,000, all the way, let's see if we can find the breakout here. The breakout didn't occur till 1983. So from 1966 to 1983, prices were basically in a sideways pattern. You know, that's 17 years of sideways action. Now we had a number of different rallies, and we had some declines, we had some rallies, we had some declines, we had some rallies, we had some declines. But for 17 years, prices basically didn't do anything. And look what happened. Every time it hit this 1,000 level, here Let's just draw something around that just to give you a little bit of a better view here. There's one time that it it kind of bounced off that $1,000 point level. Here it broke through a little bit, but it's still back down after breaking through that $1,000 level. Here we hovered around it for quite a few months before it backed down again. But do you notice something here? Let's take a look. Let's see what you can notice. Right around here. And then again here, where it finally broke through. So what do you notice about all the times that it had hit that 1,000 point level? Well, it was a very narrow level. It was only one little uptick in the bar right here, a very little narrow wick at the top of this bar that sent prices much, much lower. It was a very, very narrow two little bars that sent the stock market lower. Now, some people would argue that perhaps it was the psychological level of hitting 1,000 that caused people to sell. And that's the reason for the decline. We did it, and we came up again against this type of resistance at the 1,000 level here. We sold off even stronger for a lower low here. The next time we got up to the 1,000 level, look at that. It kind of broke through. It broke through a little bit stronger than the last time, didn't it? I mean, this time it didn't even break through, but it seemed to shoot through there, and for a couple of months it was hopeful that it could have stayed above 1,000, but again it sold off, and it sold off even deeper than the last time. The next time it came up to the 1,000 level, we had 1, 2, 3, 4, 5, 6, 7, 8, almost 9 months of hovering right around that 1,000 price level. Now, do you think that it's more significant at this point than it was here or here or here? Yes, because we spent a lot more time in that area. People became more comfortable with the index at 1,000. All of a sudden, I think they feel like here maybe they didn't think it was possible that the index and stocks could actually break through 1,000. It's very psychological. When it came back up here and it sold off dramatically, then they said, well, gee, I don't think we're going to be able to break through this 1,000 level. When it came back up here, they said, yeah, we can push it higher. And they did for a little while, and then they sold off again. When they came back up to this level again, they actually spent 9 months out of this 1967 or 1976 to 1977 area hovering around this 1,000 level. People got comfortable with that level. The sell-off from that was much less dramatic. In other words, this was a turning point in the psychology of this market. It didn't sell off as much as this point or this point or this point. And it spent a lot more time at these levels. When it came back down, it consolidated a little bit, came back up, spent another 4 or 5 months here, sold off again, but again, you've got higher lows. Higher lows was an indication that the next time this tries to get through 1,000, it would just simply break right through. And it did. It broke right through. It came back to test it again, and that's one of the principles that we're going to talk about. But it did break through this psychological level of 1,000. No longer was resistance; it became support, and from then on, boy, the market just absolutely took off. Look at the exuberant run-up here. Have we seen this kind of run-up before? Yeah, we saw it a number of times. We saw it in 1929. We saw it in 1946. There's 29. There's 46. And from there, from 1983, when the market broke through, you could see that we had a tremendous run up all the way to mid 1987. And that's why we had an exuberant run up. And what happens every time we have an exuberant run up where we have these large price bars, going right to the sky? Well, some people say it's too high. Psychologically, they couldn't take that kind of height. And prices sold off dramatically. This is probably the first time since 1929 that prices sold off so dramatically in a single day. And in fact, well, this is actually a monthly chart. Let's go to a daily chart. And I'll show you exactly what those days look like during that month. I have to go to 1987. Here we go. Right in here. We had a fairly significant run up in prices. Very, very strong prices running up to this level. We started selling off, came back up again, and then boom, it just fell apart. On the monthly chart, it doesn't look that bad. It looks like, just one big long bar down. But the fact is, this happened over a period of a month, and it was a pretty dramatic sell-off. It was a very scary time. This is when I started trading. Let's go back to the daily again. This time right here was very, very interesting, actually. I started trading right around February, the beginning of 1987, in January and February. And you can see in January, February, March, and even April, prices did nothing but continually to run up. And I was making $1,000, $1,200 a week during this time, and I thought I could do no wrong. And I knew prices were going to start pulling back, and I actually started buying some puts at these levels. And I made $32,000 over the next couple of weeks in this period, and it was tremendous. I had a feeling, because of the exuberance of this run-up, that the prices were going to fall dramatically, and they did. Except down here at the bottom, I also thought they were going to continue to go lower, and they didn't. And over the course of the next couple of months, prices continued to forge higher and higher and higher, and I lost quite a bit of money during that time. That was my first introduction to losing money in the markets. Well, if I had been right here, in this area instead of this area, I would be a multi-millionaire back in 1987. And in fact, there was a lot of people who purchased puts in this area, a couple of market makers in particular, that did make millions during this period right here. But once again, even though prices sold off dramatically, look what happened. Prices begin to stabilize. They stabilize. They move up and down. They go up and down. And eventually, what happened? Well, we had some resistance right in here, didn't we? Another psychological level right around 2,800. Let's draw a little price level there. And let's go back to our monthly chart because it's a little bit easier to see the detail here. So what happened? We hit this resistance level right around 2,750, and let's go back to our drawing tools, to our oval. We touched it here and it sold off. All of a sudden the psychology changed, because the next time we came up against this resistance level, we even though we did sell off a little bit, the sell-off wasn't very strong, and we actually hovered in this area 1, 2, 3, 4, 5, 6, 7, 8 months without a dramatic sell-off. Again, we had a price consolidation, as consolidation and movement of prices right around the significant resistance level that we hit back here. This is significant. It's a change in psychology. We finally broke through and stayed above it for a little while, and then it sold off again. But look what happened. We went right back up again, broke through it, consolidated, and then continued to move higher in the markets. So there's always, every time, just about every time, there's not too many times where a resistance point is hit. And we did, actually, when this came up, we didn't know this was a resistance point. We only knew it was a resistance point when the market sold off from it. And then when it came back up to that level, we knew it was a real resistance point because prices hovered in that area for so long. No, they didn't sell off, which shows quite a bit of strength. But at the same time, they didn't break through it. So they kind of consolidated a little bit. They started coming back up towards that price level, and now they just absolutely blasted through it. Then what happened? Well, we were in an extremely long uptrend channel here for quite a number of years. I had traced this channel going back all the way back to 1905, or maybe even earlier, maybe the year 1900. This channel and this resistance point here during the 70s was a resistance point that was significant in its breakthrough. This channel here goes all the way back to 1900, and we broke through it. We broke through it right here. That was in 1995. And look what happened. We had an unbelievable, exuberant run-up in prices, didn't we? And what happens every time there's an exuberant run-up in prices? Prices sell off. Now, there may have been some significance to the 10,000 level that was broken through here. I mean, it came up to around 11,500 before it fell back down again. I'm not sure. But I know a lot of people were talking about the 10,000 level as a resistance level, that they were afraid that the market was going to sell off dramatically. When it didn't happen, I just want to kind of focus in on this area here. When it came up to 10,000 and it didn't sell off, it actually blasted through there. It didn't hit a dramatic resistance point and sell off right away, but it did consolidate in this area for how many months? Well, let's draw a line where the 10,000 price level is. It's right here. There we go. That's the 10,000 price level. Now let's change the color so that we can see it a little bit clearer. We'll change it to orange. So you can see that it broke through, but it actually could not make much progress above that. It just consolidated. Now these are monthly bars, so this is 1 month, 2 month, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28 months it spent in this consolidation period between 11,500 and 10,000. So for 28 months, all it did was go back and forth in this 1,500 level. The bulls couldn't make any progress going up. The bears couldn't make any progress coming down until here, and when it hit this 10,000 level and it broke through to the downside, it kind of consolidated back up, and then it went back down to the downside again. So this 10,000 level, which was broken through, had become some sort of a support because it wasn't broken through until here. Then it became resistance, and it sold off dramatically after that. Then what happened? Well, We came up, we sold off, we consolidated some more, we started going back up to that 10,000 level. This time, however, it started falling back down into this 10,000 level. It kept falling below it and then closing above it, falling below it, closing above it, falling below it, closing above it. It did that for another 7 or 8 months before it finally decided to significantly blast through this price and start its upward climb again, breaking through the 11,500 level, which had been resistance for these 28 months. Where does that leave us? Well, we broke through that 11,500 level. That was just back in at the end of 2006. And this is where we are today. We broke through that level. We came back up. And now, because let's take a look at these prices on a weekly basis. You can see that once we broke through this 11,500 level, you know, it was a resistance point going all the way back to, you know, back down in here and here. And this resistance point was broken through, and then we had another exuberant run in prices. And what happens after we have an exuberant run in prices? Well, prices will sell off and back off. And look at this one particular bar here came down to. It almost came down and touched this 11,500 level, which was a significant breakthrough area, going back almost, well, let's see, all the way back to 2004. So it was a fairly significant resistance level here, and it turned into support just recently in the markets. Now, once again, we had an exuberant run up in prices. We also had a very, very long-term channel here that I had going upwards, and it fell through that channel lines, and it started consolidating. It broke back through it again, and then it started coming back down again. So we are again in this kind of a consolidation phase of the market. You know, I always like to take a look at these historical kind of trends, you know, where the market has been and where potentially it is going. Because what it does is it shows you that there's really nothing new under the sun when it comes to the stock market. These kinds of up and down movements, exuberance, sell-offs, exuberance, sell-off, exuberance, sell-off, keep happening over and over and over again in the markets. There's nothing really new in the markets, and it hasn't been anything new for over 107 years, at least as long as we can go back on this chart. Now that we've gotten to this point, a lot of people said there was going to be a very significant resistance level at 15,000, but what actually has happened is we hit a fairly significant resistance level at 14,000. 14,000 seemed to be a significant resistance level. We say it's significant because the first time that prices hit this 14,000 level, they sold off dramatically. If prices hit this 14,000 level and did not back off significantly, then we would not consider this to be a significant level of resistance. But because they have sold off here, they consolidated, they came back up to that 14,000 level and stayed above it for 1 month, but then sold off again dramatically after that, makes that 14,000 level even more significant. If you recall, going back here, we were in a consolidation phase here for several years. If we go back even further, I showed you that there was a consolidation level, you know, back in this area, that took place for even more years. This was, I mean, there was one resistance level here from 1966 all the way to 1985. This was a fairly significant resistance level at the 1,000 level that took place here that took a very long time to break through it. Do I think it's going to take that long to break through the 14,000 level this time? Probably not, because it seems like every time we hit a new resistance level, the time in which it takes us to break through to that level, above that level, consolidates and it is shorter and shorter and shorter. This time, a significant level was broken through at the 10,000 level, and it only took about a year and a half to do that. Another resistance level at 11,500 was also broken through in less than a year. So I don't think that it's going to take that long to break through this 14,000 level if we can break through it. Remember, whenever there's an exuberance in price here, there's always a back off and a consolidation. How long we're actually going to be in some sort of consolidation phase, going between, let's say, 13,400 and 11,500, I have no idea. It could take years before we get out of this consolidation area and we attempt to break through 14,000. But I am pretty sure of one thing. If trend in history is our guide, eventually we will rise up to that 14,000 level and we will break through it and we'll have another exuberant run up in prices. It seems as if every time we break through these significant resistance levels, we have an exuberant run up in prices. We did it here. We did it here. We did it here. I mean, prices just blasted. We did it here. And we had tremendous bull markets after breaking through significant resistance points. So my point in all this is simply to give you a basis, a framework for making a decision and having an understanding of where prices have come from and what is significant about the price at the current moment. So if you don't know where you've been, in other words, how do you know where you're going? That's the idea. And the idea too is that you should do some historical research on the price of your stock, because prices are personal to the individual that bought or sold at those levels. In other words, if you purchased a stock at $20 and now all of a sudden it's at 10, well, you're going to be feeling some pain because you've lost money. And when it attempts to rally back up to $18 or $19 again, you may decide, hey, I'm almost whole, I can get my money back, I'm going to sell as soon as it gets close to 20. And that's what causes these types of resistance points, because if they bought here, they're all the way back down here, and they come back close to that level again, they can sell and get whole, they can sell and get their money back, and that's exactly what happens most of the time in most of these stocks. So on the indexes, you want to take a long-term historical perspective, at least to have the understanding that the movement of prices up and down significantly is pretty much par for the course. Prices go up, prices come down. Prices go up, prices come down. Prices go up, prices come down. And like I mentioned in the beginning of this course, there's only two truths in the market. And as far as stocks go, they will fluctuate in price. Now, determining the direction of markets is really it really is an art, and you don't need to determine markets in order to be successful in the markets. You don't need to know where prices are going to be headed all the time. The couple things that you do need to be aware of are support and resistance points in which prices have backed off from significant prices, just to get an idea of what will happen to your position. The idea here is to manage your risk. And in order to manage your risk, you need to know where these support and resistance points are. They're not always intuitive, but the way I draw support and resistance points is simply by seeing how many price points these bars will touch. For example, as soon as a price bar touches a particular price level, let's take this bar right here, this white bar right here. This price bar is a weekly price bar. If we took this bar and we said, okay, well, you know what? For this week, prices, started out very high, they came down to this level, and then they closed back up at this level. I'm sorry, about this level right here. And this seemed to be a turning point. This level right here where I have this little dot seemed to be a turning point. It turned that around to bring the market back up again. So when it broke through it again, okay, it was no longer a resistance point. Now, or I'm sorry, it was a support point. Now it's no longer support. It now has become resistance. Now that it's broke through that. And actually what happened was we consolidated for a while, and it did come back up to that price level, which is the same price level here, and it bounced back down twice off of it, which now makes it even more significant price level. Let's go to a daily chart for a second. And instead of doing all, let's just do the last 9 months. This was the point I was referring to here. Prices came down and it reversed significantly off of this price level. They did eventually break through it, so it was no longer support. But over time, they did come up and test that price level again here and here. At these points, it sold off significantly. At this point, it sold off even more significantly. So there's some resistance at this point. Now, here's something that's very interesting. Remember we talked about how when resistance on the upside is broken through, usually there's an exuberance to the upside. Well, because we have a prior history here, the exuberance may not be as strong as it is if it breaks through this 14,000 level. If it breaks through this 14,200 level, you're going to see significant price increases over the next few months, and that's the time to get generally long in stocks. But right now we're still in this consolidation period. Let's go back for at least 1 year here so we can see how far this consolidation period goes back. You can see that we broke through the 11,500, and since then we've gone up to 14,200. So in this level, we have a fairly significant wide ranging prices in which we're just kind of floating around here, not making any progress to the upside, not making any further progress to the downside. And the way I measure the resistance points is the same as what I've just told you here. When I see a price level and a dramatic reversal from that price level, either to the upside or the downside, I highlight it with a little oval. I go to my drawing tools and just take out the oval tool. And I just make the ovals wherever I feel it's significant. So when I see these levels and I'm thinking about putting on particular positions, especially for the monthly income trades, what I like to do is, let's say the time that I'm putting these on is right around the third week of the month, right around where the expiration is. So for example, I'm right in here on the 22nd, which was the expiration probably for the January options. Is this a good place in which to put on trades in which I'm hoping that the price will fluctuate back and forth plus or minus around this price level? Well, knowing historically that when we have significant sell-offs in the market like we had during the month of January, generally prices are going to bounce. So a good trade at this point, and especially the VIX, would also increase dramatically. Now, what happens when the VIX increases dramatically? Well, the prices of options go up as well. In fact, they're probably at pretty high levels in this area of prices right here. It's a good time to sell vertical puts, to capture the premium on vertical puts, because generally whenever you have a sell-off like that, you're also going to get a snapback, and that's exactly what happened. Now, if I was going to add to my positions, what I would do is maybe when it came back up into this resistance level here, it would be a good time to sell some calls, vertical call spreads, selling vertical call spreads. So measuring the support and resistance points is an important technical tool in order to determine when you should be doing certain type of trading activities. That's just one way I use support and resistance points. Let's talk about cycles for a second. Why do prices rise and then fall, rise and then fall, rise and then fall? I mean, why do they do that in the first place? Well, of course, the smart aleck answer is that there's more buyers than sellers when they're going up, and there's more sellers than buyers when they're going down. And there is some truth in that. But there's also, it has to do with not just economic cycles, but also cycles in cyclical cycles in sectors. That was very difficult to say. Cyclical cycles in sectors. Say that 10 times really fast. Anyway, what happens generally is that the large mutual funds and other professionals that manage money on a professional basis for investors and 401k plans and mutual funds and all of the funds that invest on behalf of individual investors, they have to go out and buy stocks because money is inflowing from investors into their funds, and they have to go out and buy stocks. Generally what happens is there is a sector in which the majority of the mutual funds are going to be putting their money. Now they have to put in money into thousands of companies because they have so much money that if they were just to start buying a single stock, that stock would go into the stratosphere. They could, if all of the mutual funds decided one day to go out and buy shares of, let's say, Starbucks. Well, Starbucks would go from their current level of about $17.50 to probably $350 within a couple of weeks. There would be so much buying of Starbucks stock that it would just have absolutely no price resistance to the upside. And the mutual funds know that if they did that, they would never be able to get out of those positions. There's just no way. There'd be no buyers left that they could sell to. Once prices got to a certain level, they'd be the only people holding the bag, and prices would dramatically fall against them. So instead of that, they spread and they buy sectors. They buy industries. So for example, recently the big run up over the last 9 months or so has been the oil stocks. Oil, the price of oil, a barrel of oil has dramatically increased in price from about $70 last August to currently as high as $135 a barrel. Well, along with that, a number of different stocks have, in fact, gone up in price, and they are all in the oil industry. Here's one, RIG. Hess. Let's just take a look at the last 9 months because that was the biggest run-up. Oxy. National Oil Well. Now this one, it looks like it's actually gone quite a bit sideways, but it had a dramatic run before that, actually during 2007. And what else have we got? CNQ. And you know what? On a weekly basis, these even look more dramatic. Devon. And let's see who else we got here. That's pretty much it. The big stocks have had the biggest run-ups. I mean, these stocks are just absolutely incredible. I mean, you can even go back, a couple of years, and you can see what a price run this has had. Absolutely incredible. So what always happens after an exuberance of price like this? Let's say mutual funds started getting involved in this because they're far-seeing, they have tremendous research, and they knew the price of oil was eventually going to go up. Well, if they took they started buying their positions back here in a $40, $50, $60, $70 level, and now they find themselves with profits at the $155 level. And they don't buy a single stock, they buy an industry. So in other words, they've taken positions not only in RIG, but in Hess, Noble Energy, Oxy Petroleum, National Oil Well, Canadian Natural Resources, Devon Energy, Halliburton, and a lot of the other, I'm sorry, not Halliburton, that's on another list. All of the stocks, all of the energy stocks, all of the oil stocks, they're not going to take position on just one. They're going to buy the whole industry. They're going to buy the whole sector. And now they're at a place now where they have significant profits in these stocks. The question is, how do they get out of them? Well, for a lot of mutual funds and a lot of other companies that take investors' money and invest it for them, the answer is simply to go out and sell it. Just sell it. But they can't sell it all in one day, otherwise they'd have a tremendous drop in price. Very similar to the drop in price that we had right here. In this one particular stock, you can see that prices went from about 144 all the way down to 120 in a single month. Let's kind of close in on that a little bit. You can see the dramatic rise in price here. But during the beginning of February, in January and February of 2008, we had a tremendous sell-off in prices here. And pretty much the majority of mutual funds and those who manage 401ks and other investment funds, when they want to get out of a stock, they will get out of a stock, and they will probably generally do it over the period of several months because they have large positions. And those sales turn up on the charts as these large sell-offs here. They sold off, they got up to another price level where they sold off. Who's buying down at these price levels anyway? I mean, if the large mutual funds are starting to sell out of their positions, who's buying here? Well, a lot of us. A lot of individual investors who have seen this tremendous trend and are taught to buy on the dips. Yeah, it's worked pretty well so far. I mean, if you bought all of these dips, you'd be making money, right? And it does. The trends do last for a lot longer than you might think. And that is a good way to make money. In general, however, when you see large price drops with correspondingly large volume, that is a sign that institutional investors are selling the stock. And that's generally not a good sign for the future of that stock. So over the period of this time here, you saw a couple of very large sell-offs with some large volume on the downside. This is the beginning of an operation in which large mutual funds and investors, people who are investing, professional money managers and 401k plans, are starting to sell out on their positions. Generally, this happens in a way that you wouldn't be able to tell. In other words, this is a very subtle way of telling you that they are, in fact, selling out of their shares. Now, if you're not paying attention to these large one-day price drops with a large volume, then you're going to be sorry later on. Because the price, even though it may fluctuate up and down here, eventually, if there's enough selling in the stock by professional investors, this is going to drop dramatically. In fact, if you take a look at a lot of different kinds of stocks, let's take Starbucks as an example because it's one of my favorite examples. Mutual funds were buying Starbucks way back here at the 1250 level. They knew, and they had the research to back it up, that there was a tremendous demand for the Starbucks product. And at that time, they took positions in Starbucks at these price levels. And they may have even been buying on the way up to support the stock. Eventually, there was a tremendous amount of exuberance in the stock because probably individual investors right around this area started catching on to the fact that, hey, this stock has moved from 1250 up to 2250. Let's get on board. And they started pushing the stock higher. Well, at this point, the mutual funds probably haven't gotten enough profit out of the stock, so as it sold off, they began buying the dips, running and supporting the stock on the dips. Once again, the individual investor said, hey, I'm going to go in and buy the dips as well, so they're buying the dips. Now there's an additional run-up of prices, and the very smart investors were buying down here on the dips, and then as it ran up, more and more people started to take notice of the fact that, in fact, Starbucks was moving up again. There was a little resistance level right around here in 32.50, and then it broke through that, and in an exuberance of massive proportions, the stock moved up almost to 40, and eventually started selling off. Well, I can guarantee you that professional investors and mutual fund, professional investors were selling into this rally. They were trying to sell as much stock as possible to the public during this rally in order to exit their positions that they purchased back down here when the stock was only $10. They have to do this over a period of time in order not to put down the price so far on themselves that they won't be able to get out at a decent profit. In addition to that, not only are they buying the stock at low levels and selling the stock at higher levels, in addition to that, when they do go out and sell their positions at these levels, they also engage in buying activities. And that might sound strange to you. Well, if they want to get out of the stock, why are they also engaged in buying activities? Well, they engage in buying activities to mask their selling. In other words, they run up the prices are running up. More and more individual investors like us get involved in the stock at these very high levels after this exuberance run here, this unnatural run of prices that get to the point where it's almost a straight up line. And when a stock is going up every single day, every day, and then jumping sometimes and gapping up in price, individual investors who don't really understand what's going on will get in extremely late on these positions. And the mutual funds are there to sell them their stock. But on the way down, the mutual funds realize that when they start flooding the market with shares of the stock, prices are going to start dropping and start dropping dramatically like they did here. A couple of signs that their institutional investors are selling are the large volumes here. There's one here and there's one here. But what happens after they start their selling activities? Well, prices kind of stabilize and then they actually start going back up again. That's because at the same time that the mutual funds and professional investors are selling their stock, they're also supporting their stock by buying some of it back. On the next higher level, they unload even more of their stock than they bought here. And they do this in order not to drive the price down because they haven't completed their operation of selling yet. In other words, let's say they took a single day and a single mutual fund had 10 million shares of Starbucks. Well, Starbucks only trades about an average of maybe 5 to 7 million shares a day. If a mutual fund, think of yourself as a mutual fund for a second. The entire 1 day of trading is about 7 million shares. What would happen if you went into the market with 10 million shares to sell in a single day? You would get an unbelievable price drop on you. So they have to sell their shares gradually over time. And while they're selling, let's say they sell maybe 500,000 shares on this day, and they sell another 300,000 shares on this day. Well, the next day they might go in and buy 100,000 shares just to prop up the stock a little bit, because they don't want it to get too far down in price, so they can't sell it at a profit. They actually support it by buying 100,000 shares. Well, now they just unloaded 800,000 shares, but they're going to buy 100,000 shares to prop up the stock. Then as it goes up, they continually sell more stock to more investors who continually see that someone is supporting the stock here. Well, somebody's supporting the stock because the stock stabilized in price and it's starting to go back up again. And they don't realize that it's the mutual fund and professional investors that are actually supporting the stock only because and only for the reason that they want to sell more of their shares. Eventually, at some point, people are going to get wise to the fact, and there is so much selling coming into the market because now the mutual funds have gotten to the point where they have to start unloading more shares again after they've supported the stock. Well, now they start selling another, here's 1 million shares, here's 500,000 shares, here's 300,000 shares, here's a couple 100,000 shares. Okay, let's go and buy a couple 100,000 shares or 100,000 shares back, support the stock again. Individual investors see that the support is coming in, and they rally the prices back up, and now all of a sudden the mutual funds come in and sell 100,000 shares, 400,000 shares, 300,000 shares. Let's sell 1 million shares today. Okay. Boom. There goes the price. It just drops like a rock. And once again, they have to go in and support the shares. They buy 20,000, 50,000 shares. And as it consolidates, they sell even more shares. At some point, eventually, maybe around here where it dropped dramatically, or here, the mutual fund has completely taken off their books the shares of Starbucks they bought back, when it was like $10. So they've seen a tremendous rise in prices. They have now unloaded their shares to investors, individual investors, and other professionals who have seen this large run-up in price, and they fear that they've lost the getting in at an early point, and now they're going to buy at the highs. Well, once the mutual funds start selling out of their stock, now not every mutual fund is going to sell every share of their stock of Starbucks, but they're going to take the majority of their profits at this point. And what happens is when they have stopped supporting the stock on the downside, and they have sold all of the shares that they wanted to sell, now there's absolutely no support left for that stock. There's no sponsorship of that stock anymore. When it starts to trade down, when that stock starts trading down here, that mutual fund is not there to buy 30, 40, 50,000 shares every time the stock drops. Other investors are starting to realize at this point that they are the ones holding the bag. The stock is not going to sustain a $40 price level. There just aren't any more buyers coming into the market at that level. Individual investors have already bought at these levels. There's no professional support. In order for a stock to continue rising indefinitely, you need institutional support of that stock. You need someone who is in there buying that stock, 10, 20,000, 50,000 shares, hundreds of thousands of shares, in order to continue to support this price level and continue to raise the price of the stock. Eventually, because there is no support, individual investors start to get scared. They start selling their shares on a daily basis. And that's what happened to Starbucks. Eventually it just kept dropping and dropping and dropping and dropping and dropping. Looks like it's found maybe a little bit of support here down around the 16 level. Maybe once again at this level, which you can see all the way going back to, it hasn't seen since 2004. There may be some institutional support coming back into the stock, looking to purchase it at a significant price, lower price level than it was up here. And maybe they'll take it for another run up back up to 40 or even higher. Who knows? But at one time, and if we go back to 2003, the reason that people have actually mutual funds actually got into the stock in the beginning was because of the fact that they could see the trend ahead. Between 2003, hey look, the bear market was in 2000. In 2003, the bear market was pretty much over in the NASDAQ. Things started turning around. There was investment. Businesses started investing. The economy was looking much better. And they knew that the consumer was the one who was going to benefit from this turnaround in the economy. And there was going to be a tremendous amount of wealth created for consumers over the next few years. And so they got into stocks like Starbucks and ran up the price. So as Starbucks prospered, so did the mutual funds who bought their stocks. But at some point, they realized that, hey, the party is over. The consumer is no longer in as good shape as it was back in 2003. This is 2007. Now we have the housing crisis to deal with. Interest rates had started to go up just a little bit at this point. The consumer wasn't looking as good as he was, back in 2003. So eventually, the mutual funds knew that they had to start looking for other stocks that would take the place of the consumer stocks that they had purchased. They started looking around, and you can see right around 2007, right when Starbucks started selling off, that was about the time that mutual funds started getting involved in stocks that had to do with oil and gas. So there's a cycle going on here. That's my point. My point is that the stock market goes up and down based on the cyclical nature of sectors. During certain types of economies, certain sectors are going to do better than others. In the case of from 2003 to 2006, it was, in fact, the consumer that was the winner during that period. Interest rates were low. They were buying houses. They were buying big SUVs. Gas prices were low. This was the time of the consumer. Now we're changing again. In 2007, mid-2006, 2007, mutual funds realized, looking ahead in their magical crystal ball, which they don't have, that in fact gas prices are at historic low. They realize that gas is going to be a significant factor in the economy, and they probably receive, research reports stating that, there's going to be a gas crisis in a couple of years if the government doesn't do something. And so they started to put their money on the table and started to buying up all these oil and gas stocks, going back here in mid 2006, 2007. As soon as they decide that oil and gas, the sector of oil and gas stocks is going to be the next hot stock, everybody jumps into it, and the prices will just run through the roof. As soon as they see institutional support here, prices will continue to go up because those mutual funds are buying, they're selling, they're buying, they're selling. That's another thing too. On the way up, not only do mutual funds buy, but they also sell occasionally, because if they continue to buy, the prices are just going to run up on them too high. So occasionally, on the way up, the mutual funds also have to sell once in a while. But on average, they're going to buy more than they sell. For example, during this run here, maybe they bought a couple million shares, but they unload a couple 100,000 here. They buy another million shares here, but then they start unloading a few 100,000 shares here. They provide support by buying more here, selling here, buying more here, buying, selling more, buying, providing support. At this point, people start to realize, hey, this rig, this Transocean, is starting to go up in price. After all, it broke through a significant price level here at 90. Wow. Okay, now's the time to jump on. People jump on, mutual funds sell, they support it by buying, and it runs up into an exuberance kind of a run here. So that is the cycle of stocks. Right now, the reason that I believe that the market is starting to take a turn downward is because of the cyclical nature of the way mutual funds purchase stocks and sell stocks. They are getting out of their oil stocks. They realize that oil has had a tremendous run. They are starting to unload their oil stocks, and all of a sudden in the news you see how closely correlated newscasters are, associating drops in the market with with increases in oil prices. And for a while, when the oil prices went up, the stock market would go down, because there was this fear that oil prices could go significantly higher, affecting the economy, so prices of the stocks were going down. Prices of the stock market were going down. But lately, over the last few days, that correlation has pretty much disappeared. I mean, newscasters will say just about anything if they think there's a correlation. Here they use the excuse, on these days here, they use the excuse that prices of the stock market dropped because oil prices were going up. Well, on these 2 days here lately, oil prices have actually dropped in price, but the stock market continued to go down. And the reason for that was because the large mutual funds could care less about the price of a barrel of oil. They know the party's over, and they're unloading their oil stocks right now. So there's a sector transition going on. Mutual funds and large professional investors are getting out of their oil stocks. And what you want to kind of take a look at is, what is the next sector to be hot? What is the next sector that mutual funds and other professional investors are going to start putting their vast resources of money into? And that is something that you can do some research on. You can kind of keep an eye out for what people are talking about. I've heard a couple of things like, if you listen to the news very carefully, you have to kind of filter out the baloney from what's real. And they said technology is starting to come around again. Tech stocks are starting to come around again. And if you take a look at the QQQs, which is the PowerShares ETF for the NASDAQ 100, you can see that during this recent rally, the prices have run up pretty good. They have really done well and held their own in this most recent sell-off. They have stayed within their channel, and not only that, but they stayed above their 200-day moving average here, which is significant. So, technology stocks is a possible sector that could become very strong here. And that's where, maybe that's where the mutual funds are putting money. So all we're doing is we're kind of looking for clues as to which sector now is going to become the hot one. Some other people have said that financial stocks, like banks, maybe Goldman Sachs, Lehman Brothers, and some others. No, not this one, I'm sorry. I have to go back to my list here. XLF. I've got it on my watch list right here. Not XFL. So now I'm starting to watch because these stocks have had a tremendous drop in price. This financial sector, this whole financial sector. And what do we see? We see that they have sold off dramatically. We've got one lower low here. Let's see, we've got another one here. And we have a potential another one right here. And it looks like I've drawn this little resistance line here. Prices went through it. They dramatically, went up from there. They sold back off. They went below this line again. They went dramatically back up again. They went back up to these levels here, and then they sold off again. And recently now, it looks like they haven't dipped they didn't dip below this price level as deeply as they did back here, but we still have a couple of days here where it's below that resistance level. But I mean, if you're a technician, you might say, well, this could be a reverse head and shoulders pattern. It's a little too early to tell yet, but if the financial sector is starting to perk up a little bit here, this is something that I want. This is an ETF that I'd be very interested in taking a look at and doing some of the strategies that I reveal in Module 11 on. Another potential new sector, believe it or not, is the home builders. I mean, the home builders have just gotten absolutely creamed because of the subprime deal. And the economy in general has been very rough on the home builders. This is an ETF, XHB, on the home builders. And I started drawing some of my channels. It kind of broke up through one of these channels, and now I've got this uptrend channel going, but it doesn't appear that it's holding this line here. And that's very significant because when it does not hold a channel line like that and it falls below it, it shows quite a bit of weakness. In addition, the 200-day moving average, it kind of hovered above it a little bit, but now it's fallen below it. Until it moves back up above that 200-day moving average, I may not be interested in even, considering it at this point. But if it goes back and down and tests this $15 level, it might get interesting again. So we try to find some clues. We try to find clues of what the next hot sector is, and by listening very carefully to the news. People have mentioned home builders, they've mentioned financial sectors, and a lot of these guys will go on to a newscast like CNBC and not really think too much about the fact that they're kind of showing their hand about which sectors they're interested in buying in. For example, a couple of people today mentioned that Lehman Brothers looked very attractive at this $30 level. They have had a tremendous sell-off from 82 all the way down to 30, primarily due to this whole subprime mess that the financials have been involved in lately. that have really hurt them. The whole Bear Stearns thing that happened about a month or so ago, and now Lehman is getting hit pretty hard. But some people have said that this looks very attractive. Well, I'm not so sure about that. I don't think I'd be interested in buying at these levels. I would like to see some institutional support. Some of the institutional support that I would like to see are some black bars like this one, perhaps. But I'd have to see quite a few more of those to indicate that mutual funds are starting to step into this stock and support this stock. In order for this stock to really start to rise in price and give us a good run up in price, you have to see that institutional support. And the way it shows up on a price chart is simply by these large black bars, which are days in which there was more buying than selling on significant volume. So I would take a look at a stock over a period of 3 or 4 months and just measure the number of black bars there are on up days. I see one significant bar here that was fairly large compared to the days previous. There was one here after this tremendous sell-off. But other than that, I haven't seen anything really unusual. In fact, today there was a huge sell-off in the stock on very large volume. So I'm a little bit concerned about that large volume. Now, if it should pop up back up again and come back down to this level on very light volume, that shows that the selling has pretty much dried up in the stock, and maybe at that point you could take maybe a small position according to the guidelines that I give you in Module 11. So what else do I use to determine where a stock or an index, especially for our monthly income trades, how should you use some of these tools? Well, I've already shown you how I take a look at support and resistance points. And for the most part, I mean, that's pretty much all you're going to need. The Dow Jones Industrial Average here, all I do is, draw little ovals around where the prices have kind of dropped down to and then rallied against them dramatically. I hope you understand that point. I'm not drawing these oval points at a point where prices are consolidating, like around this point. That's not significant to me because even though prices sold off, they didn't sell off significantly. Here they bounced off dramatically. Right here they hit a point and they bounced dramatically higher. Same thing here. It hit a point and it bounced dramatically higher. It hit a point and bounced dramatically higher. It hit a point and bounced dramatically higher. That's what I'm looking for. I'm not looking for just about any point. I'm looking for those points in which the market has hit and there was a significant sell-off afterwards, or it was a point where the market had hit and there was an increase in prices dramatically afterwards. Those are the only points I'm really interested in. If we come into more recent action, you can see that there was significant sell-off here, significant sell-off here, significant sell-off here, a breakthrough, significant sell-off here, significant sell-off here, breaking through this prior resistance points, a little bit of a run up here, which was prior resistance a number of times going back. I mean, if I was to consider the fact that a resistance point is more significant based on the number of ovals I've drawn on here, there's 1, 2, 3, 4, 5 at this level right here, which makes it very significant. So when a price does come back up to it, you might say, hey, you know what? It dropped, it sold off here, it sold off here, and it sold off here. It'll probably sell off again. And that's exactly what happened. And that's in a daily review that I did for this day here, which was May 29th. I noticed that there was a significant amount of bearishness because it did hit this resistance point, and the next day, which was May 30th on a Friday, the daily review that I did for that day, I indicated that I was extremely bearish on the market, and I took a position, a put position in the Qs at that point. So you can use support and resistance points as determinants of where prices may go. Again, you can never predict the future price of a market, but you can manage the risk that you're in on a particular trade based on support and resistance points alone. If you learn nothing else about technical analysis, you can live and you can survive and you can thrive in the markets just based on support and resistance points. That's all that you need. Now, I've added a couple of other interesting tools to my arsenal when it comes to technical analysis, and that is channels. I like to use channels. These blue lines are actually something called V-bottoms, and you don't really need to know too much about that. The only thing that's really kind of interesting is in a very long-term scenario, V-bottoms have become significant recently. I mean, I'm just going back to like 1999. There was a significant V-bottom here in which prices ran up dramatically. And I'm taking a look now at whether or not a V-bottom is forming here recently in the markets. If in fact a V-bottom is starting to form, in the way I take a look at V-bottom is these long stem candlestick charts here. They have a very long stem at the bottom of each one of these bars, and these bars come down to form the left side of the V. And then long stems form the right side of the V as it moves up. So it's going to be interesting and significant to see if in fact the market rallies from this point and a long stem forms here, just like it has in the past. In this particular V, you had a couple of long stems here, here, and here, and then there was a long stem on the right side of the V as well. So I'm kind of taking a look at that to see if in fact a long stem, we've already got one long stem on the right side of the V. I'm kind of taking a look and keeping an eye on this one, this particular month now, to determine whether or not another long stem is going to be in place here, in which will act as support for the market to move up from this point. But channels is also another significant technical analysis tool that you can use. I showed you support and resistance points, and now I'll show you how I draw channels. Let's eliminate this channel just for a second. Let's eliminate this channel. This is actually a sideways channel. I like to take a look at channels, especially long-term channels. And the way I do that is I simply go into my drawing tools. I highlight channel here. And the way I place my channels is basically taking a look at these high points and seeing where they line up with maybe any low points previously to that. So I come down here, I start to draw one channel. All I try to do is connect the dots. And then what happens is this channel tool begins to pop out, and I can start to draw a channel here on the bottom of this. And you really have to kind of eye it. You know, where do you want your channel to start? Where do you want it to end? You know, what do you want to include? What don't you want to include? So, you know, you could make an argument for placing the channel here, because there's a little bar here touching that channel. I want as many touch points as possible on this lower channel line and on the upper channel line. There was a support level here that I liked. There was a little bit of a support here. There was resistance here. There was resistance up in here on this upper trend line channel. And I like to see as many points as possible touching this uptrend channel line, this top channel line. I also like to see, when I form these channels, as many points that touch it at the bottom as well. So that here's one point, here's another point, there's another point here, and there's a couple of points in here. And so far, it has not. Prices have not broken through this particular uptrend channel line, this lower trend channel line. So I'll be keeping a very, very close eye on that as well. So that is additional. That's additional evidence that not only is the uptrend still intact, but we may also be forming a V bottom here in prices of the Dow Jones Industrial Average. If that's the case, and prices do not significantly drop through this lower trend channel line, or drop below this V that is being formed on this V bottom. Now, if prices were to drop below this V and they were to drop below this lower trend channel line, then I would suggest that we're probably going to be in a very long bear market, or at least a trading market in between this 11,500 and 12,750 or even higher level for a long, long time. These two, basically the support and resistance points and a channel. Now this upper trend channel line is the upper trend channel line, and then this is 25% of this. And you can set that up when you do your price and when you do your channels. And I can show you too that if you highlight this, you can see that you want to, if you want to, you can show the 75% line, which is this upper line, upper middle line, and you can show the 25% line, which is this lower middle line. You can also show the 50% median line, which goes right through the center of it. And sometimes that's significant as well. Generally what will happen is as prices move down to touch this lower trend line, they will pause at the 50% line, which they did here, before hitting the 75% line and then hitting this top line here. And that's exactly what happens. I like using channels because it kind of gives me a better picture of the trend of the market or a particular stock. I also like support and resistance points, and I've given you just about everything I use in technical analysis. These V bottoms are not really that necessary. If you just learn the support and resistance points and the trends and the channels, that's pretty much all you're going to need for entering both the monthly trades as well as the trades that we're going to talk about in Module 11. And then when you add to that the price and volume analysis that I talked about earlier. For example, one of the reasons that I like Starbucks at this level was because of these large price bars here. It looked like, I mean, if you take a look at the amount of volume coming into this stock at these levels, at the 23 level, there was over 127 million shares, 137 million shares traded on that one day. Here's another one. Here's another day in which over 150 million shares were traded on one day. So it appears, I mean, people, in order to get that kind of volume in a stock's trading in a single day, you're talking about significant amount of money. I mean, think about it. 150 million shares. At this time, the stock was around $19 or $20. Just do the multiplication. $19 times 150 million shares. That's a lot of money that went into that stock on that particular day. And when you start to see that, when you see prices start to drop on lower volume, and you've got higher volume on these up days in which you've got a black volume bar here and an up day for the day, it shows a certain amount of support for the stock. I'm sorry, these are weekly bars, so that's the amount of money going into the stock on a weekly basis. Let's take a look at a daily chart here for a second. You can see significant amount of volume coming into the stock, but it did not fall in price. And then you want to kind of take a look at some of these bars, these black bars. There are a few significant ones here. Yes, there was also red bars, but for the most part, here's a significant black bar. There's a couple small bars here. There's a big bar here compared to the days previous to it. Here's some more big bars. There's 3 in a row in which there was increasing volume. Here's another big black bar here. There's another black bar here that is more significant and higher in volume than a lot of the red bars before it. There's another one here. So, and then when we had this more recent sell-off back down to from 1850 down to 1775, you can see that the volume had decreased significantly. And that usually means that there's not really too many sellers here in the market at these price levels. And it's, you know, potentially we could have much higher prices in the stock just based on that volume analysis. So, you know, this stock has been in a downtrend now for some time, and I've got it tracked by this channel, this one particular channel. This is a little sideways channel that I had in there for a while. But if you just follow this downtrend channel, you can see that it's still, you know, it still hasn't made much progress moving up. And so it could move up higher, or it could consolidate here before moving up higher, but at least there appears to be some support of the stock through these, you know, higher volume on the up days in the stock as it continues to kind of move in the sideways pattern here. So it's something that you might want to keep an eye on. I mean, I'm not recommending that you buy Starbucks stock at all, but it is something that is significant to keep an eye on. This idea of determining both price and volume to determine when to take action on a stock in a way that I talk about again in Module 11. So that is pretty much it for technical analysis. You want to keep an eye on the general economy to see when, you know, what particular type of stocks are going to be the next hot sector. Right now, institutional investors are getting out of oil stocks. What are they going to get into next? We don't know. But that is exactly the reason why you have ups and downs in the market. Institutional investors, big money managers are selling stocks that they no longer want in their portfolio. Then they start buying other stocks. They start buying other sectors. And in order for us to be successful in the market, we have to understand why these fluctuations take place. It's not because somebody just decided to wake up one day and sell stocks. It's because mutual funds are in there selling the stocks they don't want in their portfolio anymore and then buying stocks that they do want in their portfolio. And when that happens, we get the cyclical nature of the stocks going up and down based on the buying and selling activities of large mutual funds. So that's it for this section on technical analysis. We covered long-term trends, cycles and sectors, channels, resistance and support points. In the next section on technical analysis and the big picture, we're going to talk about intraday charts. We're also going to talk a little bit more about volume decline and price action. We're going to talk about candlesticks, and then I'm going to talk to you about how to put it all together in a trading plan so that you understand when, in fact, you should be putting on your positions and how you should be putting your positions on. As far as delta, either plus or neutral, or delta or neutral on our positions, you can see that if you're in a position where you're hitting a resistance point like this, you may want to be delta negative on this. If you're in the middle of the trading range and this is the time you should be putting on your positions, you're best off being delta neutral. If you're down on these levels and you believe that there's going to be a significant bounce in the market back to the upside, then you might want to be delta positive, at least slightly. So this becomes a little bit more intricate than simply buying and selling positions. Instead of simply putting on positions that we've talked about, such as calendars and iron condors and double calendars and so forth, if you have a little bit of technical analysis knowledge, then you can begin to put the odds dramatically in your favor. I'm not saying it's absolutely necessary, because the techniques that we talked about as far as double calendars and iron condors and building your portfolio will not change. The only difference is you may want to keep an eye on support and resistance points just to give you that little bit of an extra edge. Alright, that's it for today, guys. We're going to be talking about some really interesting things in the next technical analysis video. So stay tuned and trade with confidence.